Alright, what is up boys and girls, welcome back to another video. As always, thank you very much for joining me for another video on the V-shaped recovery on liquidity supply and demand here. As always, please do like and subscribe, leave a comment, really helps out the channel. Just wanted to go over this amazing strategy that I have been trading over the past few months. Genuinely have got around an 80 or 90% win rate with this, and it does work on a lot of different assets as well. I've been trading Nasdaq 100 mostly. NQ here, as you can see, I've been trading futures with this and it's been absolutely insane. Lots and lots of V-shaped recoveries that have worked quite a lot recently. And as you can see, there's actually a few here that still would have potentially worked, although this one here might have been a little bit of a slow burner. Obviously, because we've got contract rollover this week, the price action is a little bit choppy, as you can see. But this is a strategy that I've been trading for, as I said, the past few months. The V-shaped recovery strategy, absolutely insane strategy that's been doing bits for me. I'll just quickly explain what it is. So as you can see here, we've obviously got our chart. If we had our little market structure like this, let's just say it's just something like this, whatever. So we're going sideways or trending up or something, and then what you're looking for is your key levels of liquidity to get swept. You can see we've got some pretty obvious levels of liquidity here. We've got the high and the low. In this kind of bullish scenario here, I'd probably be looking for a nice retrace followed by a continuation to the upside. That'd be really nice to see. So say price does something like this, we come down and we actually sweep the liquidity below this level here. This would be a really good place to get started in terms of looking for that potential V shape. What you're literally looking for is 3 or 4 or 5, maximum probably 6 or 7 candles. Basically you want to come down, sweep that level of liquidity, and then start to come back up like this. And then at this time you're looking for a fair value gap in price on the way down, an inefficiency in the market that you can basically come back up through and get that inversion of that fair value gap back to the upside for your entry model. Generally speaking, as we know, if you study ICT concepts, the market wants to move through all these inefficiencies and basically stop people out constantly. This is why you get stopped out so much when you put your stop loss below these levels like this, because the market will literally hunt you down, find your liquidity, and then reverse on you straight away. As you can see, in this instance, anyone that had their stop losses down here got hunted. All of their stops got hit here, and then in these kinds of places you generally can see some good reversals because of the imbalance in the market being filled, and then you can move on back to the upside. So you can see here what we're looking for. This is the model. We've swept our liquidity. We're looking for that V shape. We've got our fair value gap here. If this fair value gap's getting inverted and closed back above like this, this is my model for entry. I'll enter here. I'll have my manual stop loss set below. If we close back below this inverted fair value gap, then I will be closing the trade and calling it a loss. Generally, I will be looking for a 1-for-1, and I'd probably go break even at the internal swing high once that gets hit. And this is my model. So as you can see in this scenario that I've drawn here, the internal swing high is at this level here, and then I'd be targeting a 1-for-1, and then I've also got runners that would come up for these targets, the high of day and this second internal swing high. As you can see, this is essentially the model for the trade. Pretty simple when you look at it like this, to be fair. So let's say, for example, we get the entry here. You know, generally speaking, sometimes you get a bit of chop sometimes, or you'll get your trade come up like this. So let's say we come up here, we hit the take profit. I'd probably scale half my position here, and then I'd be going to break even once we've moved through this break even bit area here. And then in this instance, if the trade comes back here, I've scaled half my position and I hit break even on the rest. That's fine. But in there's quite a lot of cases where, generally speaking, when you hit such a big efficiency like this, you do get a big reversal. There's been some great examples of this recently that I'll show you in just a minute. But generally speaking, you'll get yourself doing something like this. Really, you'll come up, you'll probably hit the second inefficiency, get some sideways movement for a while, and then come up and hit the high of day eventually. This happens more often than you would think. I'd say around 50% of the time where you get a good sweep of liquidity, this will be the outcome eventually. So this is my model. This is my example of the conditions that we're looking for, and I'm just going to go through a few of the charts and just find a few for you. I know for a fact that there was one on Friday on NQ that was a really, really good one. If we just take a look here, I've just got to go find it now. Where are we? Friday. So this one here, this is a really, really good one. The 1 minute is actually the best way to see this trade. So as you can see, if I can just find this, Thursday, I always go back way too far. Friday. Here we go. Right, so you can see here the market slowly moving up bullish, just like my scenario before. We get the open of the market, decent little pull from below. We run all the way up, and then we're coming back down here. And I'm thinking, okay, where are my two major areas of liquidity? We've got the area of liquidity up here. If I can actually, there we go. And we've got this level of liquidity down here. And pretty simply, so the markets, let me replay this so you can see this in real time. So we're coming along, I'm going, okay, the market's looking pretty bullish, and then we start retracing, breaking down below levels like this, over and over, and I'm thinking, okay, this is looking pretty promising then. If we come down and sweep this liquidity, I'll be looking for that potential entry model that I'm looking for. We get the sweep, as you can see. We've also got a nice little fair value gap formed here. You can see the fair value gap in the market, basically that gap between the first and third candle in this 3-candle pattern. We come back up. We get the close back above after sweeping the liquidity to the left, and we're in a really nice discount now after coming up so much and then back down so much, and I'm thinking, okay, this is going to be a good trade. I enter on the close, as you can see. I'll probably go break even at this level here, just because this level here is probably too close to the break even. I'll probably get stopped out, but you can see the momentum swing back to the upside here already is really, really good. And then if we play this forward, you can see we go up, we hit the take profit 1 for 1, which happens to be that swing high as well, as you can see, and I'd go break even there. So this is already a 1R and a break even trade. Got my next take profit is somewhere at this, I think it's at this wick here, because this was the data high, so we did have news. Data highs are a big draw in the market, and then obviously a bit of sideways for a while. We come back down, retest that 1R area, and then as you can see, if I just wind this on, we go up and we hit both of our targets, and this turned out to be 4 or 5R. In terms of leaving runners, obviously you scale half at 1R, and then you leave your runners the rest of your runners to go, probably 2 or 3, maybe 4R because of the distance that we traveled here. But absolutely textbook trade, completely beautiful scenario. This is the perfect scenario that you're looking for. And I was just thinking, I actually saw a potential. There was actually a gold trade today that was very, very similar here. You can see, if we take a look here, we're kind of trading in a bit of a range for gold. We're on the 1 minute here. And then we get this big sweep of liquidity down below all of this liquidity down here, as you can see. If I look across on the chart as well, on the 5 minute, you can see we've actually swept out even more, all of this standing liquidity back here as well, all the way down pretty much to this level here. So you could say we've swept out a ton of liquidity. So you're thinking there's probably highly likely you'd get a reversal from that area. And then if you zoom in here, looking for your entry, absolutely beautiful fair value gap here, as you can see. We come down, get that big liquidation of long positions down here. Obviously, all those orders piling up underneath that very, very obvious swing low. All that liquidity gets swept. We come back up here. Within 2 minutes, we get our entry. As you can see, close back above the inverted fair value gap. Aiming for a 1-to-1. The 1-to-1 gets hit basically instantaneously in the next minute. And then I would go break even once you hit that internal swing high, which would be here. So this would have been 1R and a break-even trade, and then you let the rest run back to wherever you'd like. I could have let this run for a long, long time, targeting back towards this area here, but really, realistically, once you get up to like, let me just reset this. Realistically, once you're getting up to like 1 to 5, 1 to 6, 1 to 7, 1 to 8R, you're probably going to be taking profits, aren't you? Because realistically, aiming up for these crazy 1 to 10s, it's very, very difficult to achieve these. These do happen, obviously, and you can see this was an absolutely beautiful trade on gold from last night in the morning, but you can see, obviously, eventually we did come back down, lose steam, and come back down again. It's actually another trade here, amazingly, if you look at this. Let me just, I'll do this one and then I'll wrap up. I'm just amazed at how often you see these trades. You can see, obviously, we come up, we come back down, we've got our level of liquidity here, we swept the low, we're in a nice discount again. And then we've got our beautiful fair value gap again. Obviously, you probably would have entered here. This one might have been almost invalid for me, just because if we had hit the internal swing high before we get the entry, I'd consider this invalid. So this one would have been potentially probably a break-even trade. I would have entered here, and then I would have gone break-even once we hit the internal swing high, which would have been here. So because we've moved so far away from the fair value gap, I would have gone break even once we hit probably here, or at the very least here. So this would have been a break even trade. You can see we came back round on it. But you can see there's opportunities all the time for potential trades in the market. You could say potentially this is one down here, although we didn't sweep this liquidity. This trade also would have worked amazingly. You can see here we got that really big move to the downside. Been a very, very big discount. We start to get a move back above. You could put your entry here once you close back above the fair value gap. Have your break even. Maybe here. Obviously this trade would have worked as well. You would have took profit, hit your break even. Break even would have been there. You may have got stopped out at break even depending on how this closed. But you see you could have aimed up here towards a 2 or a 3R as well. So you can see this strategy absolutely insane. It works really, really well. I beg you to go check it out because it's absolutely changing my life right now. Please do like and subscribe and leave a comment, and I'll catch you in the next video. Cheers.